Hello and welcome to this video chat on SPACS, Special Purpose Acquisition Companies. I am Nikhil Morsawala, Chief Curator and Mentor at www.mydgcfo.com. Today we will be in conversation with Rajiv Khanna, a very leading legal luminary in Manhattan, New York, a shareholder at Buchanan Ingersoll Rooney, a very prominent law firm with 450 partners spread across 15 offices in the US, and they specialize in corporate law amongst other things. And we'll be chatting with Rajiv about SPACs. I would like to introduce to you Rajiv first as a friend and then as a professional. And whilst it might take me a few hours to actually walk you through his biodata or his profile, I would like to touch upon some very key factors. The latest one, he was selected as the deal maker of the year 2021 by the Finance Monthly magazine, and that itself is a very big achievement. And Rajiv has a lot of firsts to his credit, which I will take the liberty of reading out a few of his firsts to you. He was the first legal professional to be involved with the proposed reverse merger of an Indian privately held corporation with a Nasdaq listed company. He was the first illegal professional to be involved with the merger of a US private company with a publicly traded Indian company. That is the first to his name. And he was part of the first merger for NYSE listed company, an Indian NYSE listed company with a Nasdaq listed US company. And I think these are some major firsts to his name. He has been always a trailblazer, and we are lucky to have him with us today to discuss about SPACs and to enlighten us with his knowledge, his skill, and his experience. Thank you for watching, and I hope you enjoy the show. Hi Rajiv, good morning. Thank you for agreeing to join the show. It's a privilege and honor, sir, to have you on the show. And we have already introduced you in the prelude to the show, so our viewers and our listeners know what personality they are listening to and the type of work that you have done. So consider yourself introduced.
Thank you.
We have picked a subject that suddenly become a hot topic, though I know that SPACs have been around for the more than 3 decades now, but suddenly special purpose acquisition vehicles have become like the rage, and a lot of Indian companies have started looking at this as a viable possible alternative to listing and to raising money for their expansion and their growth. So Rajiv, I know that you have been very closely connected to this industry ever since it began. Could you give us a sort of a little bit of a history on SPACs, how it started, and how it has matured now into a vehicle which can be relied upon and which is a very evolved vehicle?
So, SPACs were in rage. This flavor for SPACs comes and goes. So the first rage of SPACs was pre the financial crisis. And the SPAC model was a little different.
Mm-hmm.
And the SPAC model then was that a SPAC sponsor raised money and had 18 to 24 months to do an acquisition, which involved at least 80% of the money they had raised or was in the trust fund.
Okay.
Once they found a target, they went to their stockholders and asked for approval to merge. If they did not get that approval, then basically the SPAC had to unwind.
Okay.
The investors got their money back. Mm-hmm. The SPAC sponsor generally lost all their money. Mm-hmm. And that was a little hard on the SPAC sponsors.
Okay.
Now the model is a little different.
Mm-hmm.
In the current model, the SPAC investors can vote for the transaction and ask for the money back. So they have zero incentive to vote against the merger.
Okay.
So they can have the cake, they keep their warrants, and they can ask for redemption. Obviously, then the question arises, how do you pay for that redemption?
Correct.
If the money is all going out of the SPAC or a significant portion is.
Right.
For that, now we have the pipe market. So invariably, the investment banker knows that a certain portion of the SPAC money will go in redemptions. He has a pipe ready, pipe investors ready who come in right away and pay for the redemptions. So right now we have about an 98% success rate in SPACs.
Oh, okay.
Okay. And SPACs are a perfect model. We have a short process it's a short process. It's essentially a capital raise for a company, except it's a short process. It's a 3 to 4 month process as opposed to a 6 to 9 month process. And a lot of companies who could not go public in a normal IPO can go public in a SPAC because SPAC allows you to give projections. So it's not what's your revenue today, it is what your revenue will be in the future that the investors can evaluate in a SPAC. That's a huge advantage, the ability to give projections, which you cannot give in an IPO.
Right. So which is why the valuations would therefore be much higher than there would be in an IPO where you cannot rely on future projections and you would need to have historicals.
Well, also it allows a company which has no historicals to go public. Let me take the most acute case, Fisker Automobiles. It is going to make an EV car. Has it sold an EV car? No. Has it manufactured an EV car? No.
Oh my God.
Does it have a model for an EV car? No. But it's public with a huge valuation because people believe that Fisker will come up with, given his reputation, will come up with an EV model that will beat Tesla.
Okay.
So it allows a company in a very early stage to go public. Let me take another example. Virgin Galactic, very popular SPAC. Now, Virgin Galactic is going to take us all for a space ride. Now, do they have a rocket that can take us there? Not yet.
Okay.
But people believe that they will, and they're public at a huge valuation. Let's take another example, Sun Hydrogen. Now, hydrogen is going to be the new petrol of this decade. So everybody knows that. They are going to make hydrogen from sun and water. Have they made it? No. Have they got a formula to make it? No, not yet. They're working on it. But people believe that they will make it. And it's gone public on that basis. So there's historical numbers for all these companies 0, 0, 0, 0, 0. Take another example, quantum space, led by a Sikh gentleman out of California. Does he have any product? No. But people believe that he will. And he's public. So this is in some ways a public venture capital.
It allows you to capture future value in the present, I guess. I think that's
right.
That's
discounted the future cash flows.
Yeah, you're capturing your future value now, and you're able to raise money on that future valuation.
On that basis.
So Rajiv, I have a question for you. You mentioned in your opening remarks that earlier a SPAC had to utilize 80% of its capital for a acquisition. So is that one acquisition, or can that be multiple acquisitions, or does it have to be one acquisition?
It can be multiple acquisitions, but the multiple must total to 80. Or the money that is lying in the trust fund.
Okay.
That is the money that the investors have put.
So if a SPAC has say $200 million in the trust fund and it identifies, let's say, two acquisitions, can it spend 100 million on each of these acquisitions?
You can have 5 acquisitions.
Okay. All right. So it's not linked to,
Uh,
it's not restricted to any one acquisition.
right. It's a little more complicated because now you have to do the financials of the 5 acquisitions. You have to do the consolidated for the 5 acquisitions. But SPACs can be used for a roll up strategy.
Okay. Okay. That's
In
interesting.
fact, I'm working on one right now, which is going to do exactly that.
Oh, I see. Okay. And they can be in multiple geographies?
They can be in multiple geographies. Normally, I would imagine that you would have to have a common theme. So, if it's an EV driven SPAC, it should be 5 EV companies in
Okay.
5 jurisdictions. Or if it's an ITS, it should be 5 of them in, but of the same kind.
Of
It's
the same
can
kind.
be one is doing hydrogen, one is doing EV, one is
Okay.
doing something else.
Okay. That's not okay. And so for the benefit of our viewers, I know that SPACs have sponsors, and that so can you explain to our viewers what's the role of a sponsor or the sponsors during and after the acquisition? Is there a management oversight? Is there a management override? Is there any management involvement of the sponsors in the acquired company?
There could be, and there could not be. It depends. So there are a lot of SPACs that are being raised by financial players now. So they are PE funds, they're investment banks that are raising SPACs. And I would suspect their role in management after the de-SPAC process is going to be limited. But it could also be a management team that stays with the SPAC after the de-SPAC process.
So can you explain what this de-SPAC process is in brief, if you can? What is a de-SPAC process?
A de-SPAC process is when a SPAC essentially converts into any other publicly traded company.
Okay.
So the de-SPAC is when the SPAC merges with the target.
Okay. And it ceases to be a SPAC and becomes an operating entity.
Yeah, it ceases to be a SPAC and become just like any other public company.
Okay. And this pipe that you spoke about, which is used for repaying the early anchor SPAC investor who wanted his money back, this pipe happens post acquisition.
It happens almost simultaneously because you need the money. And it's not just linked to paying the redemptions. It can be also linked to more money that is needed for the process. So if the operating company is going to need another 100 million, it's going to have redemptions of 100 million. So you could raise a pipe of 200 million.
Right. Okay. And in terms of regulation, Rajiv, SPACs are regulated by the Securities and Exchange Commission, I guess, by the SEC.
Right.
But are there any specific rules and regulations that prospective corporates in India who are looking at SPACs should be aware of that could prove to be a challenge or that they need to be aware of?
Well, I think the SEC has started looking at SPAC sponsors more closely. They're asking the SPAC sponsors to explain the vetting process a little more. But as long as you have a credible transaction, I don't see the challenge.
Okay. And from what you just mentioned about capturing future valuation, I guess the pedigree of the promoter of the company that's being acquired assumes that much more importance because there is no product or there is no actual. I'm talking about pre-revenue companies, obviously. If there are companies which are already having revenue, this question may not apply. But for pre-revenue companies, for companies which just have plans on the annual and have a long-term revenue profile. How important is it going to be to establish promoter credibility? Do you think that's going to be a very key factor?
I think the credibility of the team that is merging, the target, is very, very important because that's what they're banking on, that these people will be able to deliver.
In terms of costing, Rajiv, if I was an Indian company looking at merging into a SPAC and getting access to that the money and for expansion, how as opposed to getting into an IPO process, how would you compare the two purely from a costing perspective?
Well, the costing of a SPAC is not cheap. It can be 10%, it can be anywhere from 5% to 15% of the money that is raised. But then you get the valuation upfront. So if you do an IPO, you will hire an investment banker that'll take you through the roadshows. He will give you no clue
Yeah.
of what you're going to raise in the IPO, at what price.
Yes.
You'll have a pricing meeting almost the day after the roadshows, the day before you're going to go public, and you are generally screwed. Why? Because investment banks want to sell to the institutional investors at a cheap value. That's why you see companies like Snowflake, they go public. The institutional investors get the stock at one price. It almost doubles on the first day of opening. What does that mean? That means the investors and bankers sold the stock cheap. I mean, it's good. It's good if it goes up 10, 15%. But when it goes up 100%, I have to ask myself, what did the investment bank do? They just sold my company cheap to institutional investors that they have a relationship with.
Yes.
And they wanted to oblige.
Yes.
Why could they not have sold? Why could they not have predicted the demand for the stock?
Yeah.
So if you look at it that way, yes, they paid 7% instead of 15%, but really they paid 57% because they sold the stock for half the price.
Absolutely, I agree with that logic. Absolutely, yes. So would you? I mean, again, this is not. I know it's a very general question, and sometimes you have to look at specifics. But on a broad general level, would you say SPACs would score over an IPO process? Broadly speaking, if you were to weigh all the pros and cons,
definitely, any day.
Okay. I know you're very familiar with the Indian law as much as you are with US law. You think the Indian regulatory framework today, which exists right now, is compatible with Indian companies wanting to do a merger with a SPAC, or is there some regulation you think changes are required for this to happen?
So the Indian regulations, like all good Indian regulations, are terrible. That's the only one way to describe it. The Indian regulator is not the solution; it's always the problem. Whether it's a SPAC transaction, non-SPAC transaction.
I know you're blunt, so I know you're very blunt about these things, and I appreciate that.
Right. They find every way for money not to come into the country. And they find every way for the private sector not to prosper. So we have two bad regulations here. One is under the Tax Act, where when in a traditional SPAC merger, the target company's shareholders exchange their shares for the shares of the SPAC.
Right.
So when you do that in an Indian context, it's a taxable transaction.
Okay.
So right away, you'll have to sell some of your SPAC shares to pay for the taxes. Okay. That's problem number one. Problem number two is the great theory of round tripping, which some idiotic bureaucrat came up with, where an Indian shareholder cannot hold stock in a company, which then invests into India. So that's a second.
Considered to be round tripping. Oh my God.
That's considered to be round tripping.
Oh my.
So that is the second big hurdle that you have.
Okay.
With SPACs today. Mm-hmm. So we try to overcome that hurdle in two ways. One is we try to externalize the holding company.
Oh.
And we have many tax efficient strategies to do that.
Okay.
It doesn't mean that you get away with no tax, but it minimizes the tax burden.
Okay.
And the second thing is we try to, if that doesn't work, and it works in a lot of cases, especially in early stage companies.
Okay.
But if it doesn't work, then we try to structure the investment as an FDI, giving the
Okay.
existing shareholders right, but not the obligation to convert their shares at a later date, hopefully when the regulations get better.
Okay.
Or when they're about to sell their stock, they can convert it and sell it.
Okay.
So those are some of the broad, and that's a very broad brush answer. There are a lot of nuances to both the structures.
Yeah.
But the bottom line is that it can be done. My great hope is that if Geo merges into a SPAC,
You will definitely see a change in the law.
the change in law will come. And the rumor has it is, and it's only
I
a
know
rumor,
you hit the
that
nail
it
on
is
its
in
head.
works.
Yeah, you hit the
That
nail on
is in
its head.
works.
Yes, absolutely. And Rajiv, for the benefit of our viewers and listeners, Buchanan Ingersoll Rooney, I know, are a very big firm in Manhattan, and you are an important part of that firm. If Indian corporates who are listening to this or watching this want to reach out to you, what are the services what does Buchanan in this whole process of the SPAC, in this whole process, how can Buchanan be of assistance or help to our
So we can find the SPAC,
okay.
and then we can do the legal process of the merger with the de-SPACing with the SPAC.
Okay. And who are the other people
We can also
involved?
form a SPAC for people
Oh,
if they're
really?
interested. Yeah.
Really? Okay.
In fact, I'm looking at 2 transactions right now where we are going to form SPAC for Indian sponsors.
Okay. So a sponsor need not be a US a citizen. A sponsor can be a foreigner.
Yeah. It can be from any part of the world.
So even Indian sponsors can incorporate a SPAC, get commitments for investment, and get it listed on the NYSE.
That's correct.
And the listing is only on NYSE, or it can be on any of the other platforms like
It's
NASDAQ.
mostly, actually, it's mostly on NASDAQ.
It's mostly on NASDAQ. Okay. Okay, that's interesting. And who are the other players in this whole chain of transactions? So a law firm is one, so Buchanan plays a big role in that. But do you need an investment banker, or who else do you need in this whole process?
Well, the accountants come next. You need accountants because you need GAAP or IFRS accounting, preferably GAAP, US GAAP. So they have a big role in the process.
Okay.
And then there are investment bankers also.
Okay, good. In terms of vertical preferences, do you see a sort of a vertical focus from SPACs in the current environment? Are they focused on certain industries or certain verticals, or it's very agnostic?
It is mostly geared to the new age companies, the EVs,
Okay. Renewable energy.
the hydrogen companies,
Okay.
The biotech companies. So if you have a company, which has got very steady business, growing steadily every day, SPAC is probably not for you.
Okay, I get it.
You got historicals, right?
Mm.
You can go public on your historicals.
Right.
If you have a new idea, a new age company, or if you're doing a roll up, and you are the company that can go 10x in a couple of years, then SPAC is the way to go.
Okay. And is there a size preference? Do SPACs look at a certain investment size or a valuation size, or
So the target has to be generally 3 times the size of the SPAC.
okay?
So if you have a SPAC for $300 million, they're looking for a company worth $900 million.
I'm a little confused. Can you explain that? Why would that be? What is the
Because the SPAC doesn't, because there's a certain amount of dilution So the SPAC sponsors get certain amount of the company for free, not free, but very cheap. So in order to spread that dilution across the board, the target has to be 3 times.
Okay. Okay. So if I had, so for Indian corporates, you would say that any company with a value, and SPACs, I believe, are of average SPAC is 150, 200 million, an average SPAC.
No, they're getting big now.
Now getting bigger.
300 million, 500 million, billion,
Okay.
all the way.
So a typical profile of an Indian company which would be of interest to a SPAC would be of a size of, you're saying, above $500 million, more or less,
Yeah, at least, at least.
at least. Okay. And that would be in terms of the valuation, or is it in terms of future projections or future capital expenditure requirements? So
Valuation is based on future discounted future cash flow.
okay. So that's what they would be looking at.
Mhm.
Okay. Very interesting. Any other advice you would sort of, because our viewership is mainly Indian corporates. So any advice from your side on whether they should be looking at SPACs, which type of company should be looking at it, and what is the right, and what's the timeline that one can. So if I start looking for a SPAC today, how long does it take for me to complete the whole transaction?
About 4 months.
4 months. Okay. Great. And any other advice to our viewers there? Would I know you are a great lawyer, but I know you have a great business sense, your business acumen, and I am personally witness to that. So, what would be your advice to our viewers regarding future fundraise, and should they be focusing on SPACs or not?
They should be, because a lot of these companies really cannot go public in India. Can you imagine a zero revenue
Absolutely.
company
No way.
going public in
SEBI
India?
will throw the prospectus out.
Right, right. But if you have a great idea,
Yeah.
and for example, if you have a great idea, even a one prototype or no prototype, then that's the way to go.
Okay.
It is a public venture capital.
Yeah, so I think that about sums it up. That phrase that you use, public venture capital. I think that's a very, very, very good way of defining what a SPAC is all about and what promoters in India can expect. From just one last question before we because I wanted to keep this short and interesting for the viewer. Uh, does the current management risk have the danger of losing control? Because a lot of promoters are very, in India especially, are very conscious about the danger of losing control over what they believe is their child, and therefore are a bit finicky about that. What's been your experience in this? Do sponsors of SPACs generally take over managements? Do managements have to move out? What's your view on that?
Generally, the target's management keeps the control.
The target, that means the company that's merging into a SPAC will continue to retain control.
Right.
There is no real danger of somebody coming in and saying, "Hey, I don't want you here. Please go away."
Look, a public company in the US is always subject to a hostile takeover.
Yeah.
So that danger after DSPAC is there. If your performance is not good, you may get somebody, an activist coming in and telling you, you're not running the company well, or you should be running it differently, insisting on a board seat, and forcing you, frankly, to make changes. But that's all healthy, because that adds value. It keeps you on your toes.
Yes. But it does not happen from the sponsor side. The sponsor does not insist on doing these things, on
No,
getting
you got to deal with the sponsors right at the beginning, right?
at the beginning. And there's a shareholders agreement or something. Is there a document that dictates this relationship with the sponsor?
A shareholders agreement is always there in a private company, never in a public company, not
Never.
even in it.
Yes. Yeah, I agree. So that would not be possible. It would largely be an understanding at the board level.
Right.
Great. I think this has been very interesting, Rajiv, and I'm sure a lot of our corporates would want to know more and may need to reach out to you. So at the end of this video chat, I'll be sharing your email ID with the viewers. So hopefully you'll hear from them. If people reach out to us at mydgcfo.com, we will reach out to you. And you are my go-to person in New York. So anything, not just law. You are a good friend, you're a mentor, and you're a very good human being. I have experienced that. Thank you very much for your time on this show, and in advance, happy Easter to you. Tomorrow, Sunday, resurrection of Christ. Hopefully, this world will resurrect from the virus.
Well, I think the virus is kind of behind us.
Yeah.
We are looking at 6% growth rate in United States. It's
Wow.
unheard of. It is unheard of.
And that too under Mr. Biden.
That too under Mr. Biden. So it's they say this decade for United States is going to be like the Roaring 20s.
Wow. Lovely.
So
and it's good for us to have you right there in the middle of all the action on Wall Street, so we can reach out to you and have a little bit of that action.
Right. And the other last point I'd like to make is that once you are public in the US, you are limited by what you can deliver. You are never limited by capital.
Perfect. Yes.
Because you can always do an ATM at the market offering, raise as much money as you want on any given day.
Yeah.
So it's you are free of the constraints of capital. You are still constrained by your performance and your ability to deliver.
Absolutely.
But the market will give you as much capital as long as you're delivering or have a promise.
Perfect. That's absolutely golden advice. I think you viewers must take that as a huge takeaway. You deliver, capital is never a problem. Absolutely
right.
Absolutely right. Well, thank you very much, Rajiv, especially joining me on a Saturday morning, your time. And again, wish you all the best. My good wishes to you, everybody at home. And I look forward to being in touch with you.
Good talking to you.
Thank you, sir. Thank you very much. Bye-bye. Bye.
Bye.